Good afternoon, and thank you for taking time away from your families and businesses during this challenging time to join us for this epic insight. This is Brian Lenz, Director of Sales and Strategic Partnerships at Epic Retirement Plan Services, and I'll be your host for today's call. At this point, the CARES Act needs no introduction as it's been dominating headlines both in and outside the retirement plan world. And today we're privileged to be joined by Pete Swisher to talk through some of the details of the Act with a focus on highlighting urgent action items for small businesses while also pointing out important retirement plan implications. Pete Swisher is a retirement plan industry veteran and expert who recently launched Waypoint Fiduciary, which he describes as a think tank, consultant, and expert fiduciary for the U.S. retirement plan system. Prior to that, Pete served as a senior vice president, national sales director, and national practice leader at Pentegra Retirement Services. He was also a founding member of NAPA, the National Association of Plan Advisors, and has worked firsthand with policymakers on issues shaping the retirement industry today, including the Secure Act and DOL fiduciary rules. Your lines will be muted throughout the call, but if you have any questions to run by Pete at the conclusion of the session today, feel free to enter those in the GoToWebinar questions panel. I see that we already had a few come in, and we'll look to address as many as we can after Pete wraps up some of his thoughts. So with that, I'll turn it over to Pete. Thank you.
Thanks, Brian, and welcome everybody. I am honored to be able to talk to you today about this stuff, even though the circumstances are awful for everyone. And as a bit of perspective, just from a pension side, this is geeky pension stuff. We're going to talk about retirement plan stuff that's a little bit detailed, that's administrative. And the prior framework for this is really disaster relief provisions that we see every year or so. So there will be a hurricane, and then there will be some sort of a relief provision. And it'll give things like relief for plan sponsors from filing their Form 5500 for a certain period of time while they're recovering from the hurricane. So this falls kind of under the heading of that. And one of the points that I'm going to emphasize is that the retirement plan stuff was an afterthought to CARES. The CARES Act is about everything but retirement plans. There are only a handful of provisions, but there's almost certainly more coming. So I'm going to talk not only about CARES and what's in it, but also what are some of the other issues and problems people have in this kind of unprecedented time, and what other forms of relief is the industry looking to get government to agree to. So with that, I'm going to start with the big picture. So we have relief legislation started with the March 6th passage of the Coronavirus Preparedness and Response Supplemental Appropriations Act. So as the name implies, this was a spending bill. And it had to do with what will we provide money for? What sorts of programs will we provide money for? And it was tagged as being an $8 billion spending bill. We then had the FFCRA, Families First Coronavirus Response Act, on March 18th, which is a $100 billion spending bill. And I'll talk a little bit about what was in those two. And then, of course, CARES was March 27th, and that was more than a $2 trillion spending bill. And as most of you are probably familiar from watching the news, it's probably not going to end there, that there's almost certainly going to be a phase 4 and even a phase 5 and maybe beyond of legislation that we can put under the heading of really emergency legislation. So obviously a unique event in our history, and there will be more to follow. So just briefly, what was in the first two relief laws? In the Appropriations Act, one of the focuses was just on affordable vaccines. And I think there are folks who would like that to be free. So how do we make vaccines free? But this is a global problem. It's not going to, the vaccine problem is obviously a much larger one than we're talking about. But that was what some of the money was earmarked for, being able to do telemedicine for Medicare patients. And then it added information about these EIDLs that you've probably heard a bit about, the Emergency Injury Disaster Loan through the Small Business Administration. That was followed up then by the FFCRA, Families First Coronavirus Response Act, and that covered things like paid sick leave and mandatory paid sick leave. So if you're a small business, you didn't have the option unless you apply for a waiver from the Department of Labor to be able to let people go out on extended sick leave, extended circumstances, provided some other government benefits as part of that, as well as additional protections for healthcare workers. So these were the first two attempts at relief bills, 8.3 billion, 100 billion, and then we get to CARES, the CARES Act, which was more than $2 trillion and included a whole bunch of spending, as you all are familiar. So again, there were some retirement plan provisions. Obviously, that's what we're talking about today. But as I said, we'll talk about what else was coming. Obviously, CARES includes the Payroll Protection Program. Just as sort of a side note, like most of you, I know a number of small business owners, including me now. But I know that the program went into effect nominally, the Payroll Protection Program, on April 3rd, which was Friday. Most banks weren't really ready. The Small Business Administration really wasn't ready. So I know that some of those are live and that there was a limited amount of funding that was available for that program. So there was a certain, $400 billion or something out of the $2 trillion was allocated for this program. I have heard that it is Congress' expectation that part of what will come in phase 4 is an expansion of the CARES program. So a likely thing that we might see by the end of April in phase 4 relief would be an expansion of CARES. Expansion meaning clarify things that need clarifying, fix things that need fixing, and expand the amount of money available for certain programs like Payroll Protection Program. Of course, we don't know that for sure, but this is what I'm hearing. So April 3rd was the first date. That was for businesses. And April 10th is the date when self-employed people can begin applying. And again, I don't think the banks were ready, but I'm throwing this in there because it's probably one of the biggest things going on for many small business people today. This is my perception of what is likely to play out with that particular thing, is that even though the funding limits are uncertain and the banks are acting faster than banks ever want to operate, even though there are unanswered questions, and even though the money itself can run out, again, it is likely that there will be another bill. So my belief is that businesses who qualify will get a chance to apply and get the relief. But it is entirely possible that some will miss out, and being able to apply sooner rather than later is therefore important. So I think in the next week or so, we're going to see a mad rush for people to do that. I've also heard that because of know your client rules, it is difficult for a bank to accept a new client when they're not currently a bank client. And if you just think about this for a second, this is just an example of how moving quickly makes it difficult to administer things. And that's going to be true on the retirement plan side, as I'm going to talk about. Imagine being a bank and knowing that some of the people applying for this relief from the U.S. government, there's going to be fraud, that there's going to be people applying for relief, trying to get money out of the government who don't qualify for that relief. And what do you do about that if you're a bank who's technically the one loaning out the money? This stuff's going to be tough to administer, but I think these are great measures, great programs, and that they're going to take effect. And I am very hopeful for all of our future. So let's dive into the retirement plan stuff, which really we can summarize as being distributions. So we have some liberalized distributions from retirement plans, plus loans and retirement required minimum distributions. So it's really just about being able to get access to retirement funds on a more favorable basis. That's really what the CARES Act provides. And the primary provision is this access to withdrawals without the additional income tax. So to clarify a little bit what that means, you have a retirement plan, you contributed pre-tax, let's forget about Roth for a second. You pay tax when the money comes out, and if you take it out early, a premature distribution, you pay, usually people call it a penalty. The technical term is it's an additional income tax. So the 10% additional income tax on withdrawals is the penalty for a premature withdrawal, meaning prior to 59.5 for the most part. So that is what's been waived. The 10% is what's been waived. So if someone qualifies for this relief, they can do a distribution on terms that they would not otherwise have been able to do the distribution, namely that they can do it without this 10% additional income tax. You see the expression there, 72T. So Internal Revenue Code Section 72T is where you find this additional income tax and also the exceptions to that tax. And what it's saying is that the penalty shall not apply to any coronavirus-related distribution. So obviously we need to define CRD, or coronavirus-related distribution, which I'll do in a second. The limit is 100 grand per person. And there is a burden on the employer in that if you have more than one plan, you've got to make sure that that limit is not exceeded for all of those plans. So in other words, the qualification status of the plan could be affected, meaning more or less that there's just a correction needed. Hypothetically, there's a burden here for employers, but I think realistically, the regulators are not going to be coming after employers who somehow let slip that somebody took too big of a withdrawal. But there are correction implications, and that is a burden nominally on employers. Another huge provision is that this can be repaid. So let's say that I am a retiree and I take out $100,000 where I ordinarily would have taken out none or less. But I go ahead and take out $100,000, but then over the next few years, I decide I can pay it back. And so I start putting money back into the plan. That will be treated as a rollover. So I take the money out. I don't pay the 10% additional income tax on it, although I do have to pay tax. We'll come back to that as well. Now I have the money. It ends up that I am able to repay my retirement plan account, and I want to do so. I can put it back in over a 3-year period that begins on the date of distribution. The retirement plan, or the IRA, has to treat that money somehow. It will be treated as a rollover. So basically, treat it as if it was a trustee-to-trustee transfer. You can't use this as a backdoor way to get a Roth IRA or a Roth account. So you can't distribute from a taxable account and then recharacterize it as a Roth. The technical wording for that's a little different, but I think that's the implication. This goes to the speed. The withholding speaks to the need for speed, so to speak. Ordinarily, when you take a withdrawal from a retirement plan, you get a tax notice called the 402F notice. And it's this plain English document, which means it's a dense 7 pages of discussion about tax implications of withdrawals. I'm not saying you shouldn't send those notices, but because the tax implications are different, the requirements have been waived for purposes of this special ability to do this distribution. So my interpretation of this, what I'm understanding so far is, at a minimum, what that means is that you don't have to worry that your 402F notice does not include this special language about the tax implications of the withdrawal. Also, you don't have to do any withholding. So again, if I'm that retiree, and I'm using the example of a retiree for a reason I'll come back to, I take out $100,000, and ordinarily when you do a withdrawal where you actually take possession of the funds instead of a rollover, there is withholding. No withholding applies. So what is a coronavirus-related distribution? So first of all, it's from an eligible retirement plan, which also requires definition, and I'll come back to that. But simplistically, it's all the usual suspects: 401k, 403b, governmental 457b, and so on, or an IRA, to an individual who was either diagnosed with the virus or the disease. So it doesn't say and, it says or. So you're diagnosed with either the SARS-CoV-2 virus or the COVID-19 disease, and that diagnosis was through a CDC, Centers for Disease Control, approved test. So that's the legal definition, although this is my summary of the legal language of who qualifies for that. So it's either you or your spouse or dependent who had this diagnosis, or you qualify through adverse financial consequences. And because that's obviously a pretty broad thing, I went ahead and included the language here, and I think it's worth just taking a second to look through this. If you experienced adverse financial consequences as a result of being quarantined, furloughed, laid off, having work hours reduced, being unable to work due to lack of childcare, closing or reducing hours of a business that you yourself own or operate, or other factors as determined by the Secretary of the Treasury. If any of those things related to the virus or the disease happen to you, you qualify for this distribution. So this is obviously extremely broad language. And if you think about administration of this sort of requirement, the ordinary approach to administration of qualified plan requirements by the Treasury and the Department of Labor is nitpicky, extraordinarily nitpicky, right? I mean, they're insistent on the rules being followed. I'm not saying we won't follow the rules. I am saying, though, that this is an unprecedented time, and I don't think there's going to be a whole lot of questioning of exactly what circumstances qualified as adverse financial consequences. So not only is the language extremely broad, seems unlikely anybody's going to look at it. So the practical effect of this is, if you want to take money out of your retirement plan for almost any reason right now, you can do so without a 10% additional penalty is my rough interpretation. But those are the technical definitions of who's eligible. So out of which plans, again, 403B, governmental 457B. So remember, 457B plans can be either governmental or non-governmental. And the non-governmental plans, and eligible, ineligible, long story short, a governmental 457B that is the governmental equivalent of a 401k, that type of plan is eligible. So if you work for a not-for-profit and you're eligible for that not-for-profit's 457B, this does not apply to that kind of account. That is technically a non-qualified deferred comp plan that is treated more like non-qualified deferred comp on the corporate side than like a 401k. This governmental 457B is more like a 401k. And any qualified plan, so whether it's a DC plan, a DB plan, and so on, 401k, and then any IRA. So these are all eligible retirement plans. More or less, this is the list of plans you can do a rollover from and to. You can do rollovers from and to these types of accounts more or less freely, and you can do the withdrawal with the coronavirus relief for all those same types of plans. Another helpful relief provision for those taking this withdrawal is the income spread. The income inclusion spread is what they call it. And what this means is that when you take the money out, so we go back again to our retiree with a $100,000 withdrawal, that's $100,000 that's going to hit that person's income taxes for the year 2020. So when he or she does taxes next year, there's $100,000 of additional income, which will likely push that person into a higher bracket and cause them to actually pay even more income tax than they would have paid if they just took it out a little bit at a time. So that is like an additional income tax of itself. The fact that including all that income simultaneously would push someone into a higher bracket is another form of additional income tax. So you can spread it out over 3 years. I have seen it written, a couple people wrote this as you can pay the tax over 3 years. That is technically not correct. You can include the income over a 3-year period. And by including the income over a 3-year period, that presumably will lower your tax bracket in any given year, or at least limit the risk that you will go into a new tax bracket. But again, you are still paying tax. So you do a $100,000 withdrawal. If your marginal tax rate on that withdrawal is 15%, that's still $15,000 of tax that you're going to pay on that distribution. Only including it 35,000 or whatever, 33,000 at a time, obviously lowers the tax in any given year to more like 5, and that's helpful. But you still pay the tax. Okay, loans are the next provision that were included as part of CARES. More or less, this is an extension of the relief with respect to distributions. So the loan limits have been increased to $100,000 instead of $50,000, and the loan limit has been increased to 100% of the balance instead of just 50%. So ordinarily, when a participant takes a loan from a qualified plan, the limit is $50,000 or 50% of the balance, the vested balance, whichever is less, the lesser of those two. Well, now you can take your entire balance up to 100,000 instead of up to 50,000. There is also a payment holiday, and it's not described that way in the legislation. That's just my term. But there's a payment holiday through December 31st of this year. And in other words, you don't have to make a repayment during that time period. And then part of what is going to be really no fun whatsoever for those of us who do administration of qualified plans is figuring out how to account for this stuff. This is going to be a nightmare. I mean, I have no doubt whatsoever. This is going to be a nightmare for the administrators. It's going to be a nightmare for the record keepers and the TPAs to try to program this stuff into the system. And it's going to be a nightmare for the employers who are going to have to figure out how to do the payroll side of it. And maybe nightmare is too strong of a word. This is, again, a very helpful provision, but the devil's in the details. And the loan system for retirement plans in the United States is set up to be fairly automated these days. And yet, we still have all kinds of problems with loans. So even under normal circumstances, loan errors are fairly common. And when the Department of Labor and the IRS do investigations of retirement plans, which we usually call audits, they find problems, they find errors. And I think it's fair to say that the administration of this provision is going to be pretty manual, and it's going to go wrong more often than it used to, and it already used to go wrong a fair amount. So this is going to be tricky, but if you think about the impact for an individual, let's say you're not a retiree. The retiree can take the distribution and pay the tax. Well, what if you're not a retiree? Well, if you're not a retiree, you may not have access to the distribution. That's something else I will come back to, because those distributions have to be authorized by the plan. The law says you don't have to pay the added additional income tax, the 10% penalty. It doesn't say you're allowed to take the distribution. So are you allowed to even take the distribution? That's a whole other point here that I'll come back to. But might be better instead to take a loan. Well, loans are going to have to be repaid over a 5-year period. So part of the relief is we can push that back by a year, basically. We can have a payment holiday through the end of the year, and then we can re-amortize ignoring that period. So we can take our 5-year limit, because qualified plan loans have to be repaid over a 5-year period. We can re-amortize the loan, and we can pretend that this period of time did not happen, which effectively just pushes back the date. So no payments for now, and then when payments resume, the payments will be based on a 5-year period that doesn't include the current period. And there's some, one of the things that could be a correction here. The wording of the law itself says that the loan limit is increased for a 180-day period starting on March 27th. So fast forward, that's going to put the 180th day at the end of September. But then this amortization schedule talks about a period that is 180 days from passage of the legislation or 12/31/20, whichever is later. But this other provision didn't say that. Well, for consistency, that second bullet point probably ought to have been whichever is later, 12/31/2020, or March, or passage of the legislation date, which was March 27th. But this is, again, one of those details that'll be tricky to implement. For employers, I think it's fair to say that all they're going to have to worry about is getting the new stuff in the system the way that they're told once we're ready to tell them. So we go through this manual process. I want to talk through the mechanics for a second. And this is evolving, right? Because this is a new law. But let's say that you are an employer, you have a plan, you've got a participant who says, I heard about this ability, I want to take a loan. Well, how do you go about doing that? Well, you're going to contact the record keeper, and the record keeper is going to have to go through a manual process of some sort to get the money out of the plan while manually documenting that this is a $100,000 loan instead of a $50,000 loan, and figuring out when the new amortization schedule is going to be done. And in the meantime, because there's a payment holiday, the employer will not have to worry about getting that information into the payroll system. So from the employee's perspective, okay, I can get the loan, and somebody's going to have to figure it out. There's going to be a burden on call centers to try to handle this stuff, longer wait times. I'm sure we're all familiar with that going on right now. But ultimately, the employee gets the money out, and someone else will figure out how it's got to get back in and let them know later on. But there will be a repayment period starting in January. And the employer in January will need to get that into the payroll system. Okay, I said that the plan must allow the distributions. just like it must allow loans. So what if you're a worker who is in a plan where loans and in-service distributions are not permitted? So, and this is not uncommon. There are a number of plans, although it's a minority of plans, but there are a number of plans that do not allow loans. And there are quite a few plans, probably the majority of plans, do not allow in-service distributions prior to age 59 and a half. It used to be fairly common to not allow any in-service distribution. And an in-service distribution or withdrawal just simply means you are still in service to the company. So in-service withdrawal or in-service distribution means you're still working for the employer. And you're not allowed to take your money out of a retirement plan until you retire, unless some other provisions apply, like an in-service distribution provision. So ISD, in-service distribution provisions, need to be included in the plan if you're going to get your money out prior to age 59 and a half. If you're going to take a loan, the plan has to allow for loans. So if you're in a plan that doesn't have those features, what do you do? And the answer is you need your employer to do an amendment and change those provisions, or you won't be able to get your money out. That is my interpretation of this. Now, that's not that hard. But again, there's a customer service and mechanical aspect that we have to work through all this. And I'll talk in a second about amendments, because there's an idiosyncrasy here about amendments as well. But if your plan allows in-service withdrawals, there are some other complexities here. So it's not as simple as, oh, I have a $50,000 balance in my retirement plan. Well, maybe $5,000 that is unvested employer contributions. Well, that's probably not distributable. And the system needs to take that into account. That part won't be a problem for those of us on the retirement plan community. But when are these provisions, when are you allowed to have access to this stuff? Well, adding an in-service distribution provision or administering it gets complicated by the fact that you have rules about which contributions are put you in the category of being eligible to take the distribution, like it's aged for 5 years, or 5 years of participation, or the contributions have been aged for a certain period of time. And again, we're set up to handle that on the retirement plan side. But one of the things that gets a complexity that interacts with this is somebody now vested when they wouldn't otherwise have been? And I'll talk about that in a second as well. So what I'm saying about the in-service withdrawals is that there are some mostly unforeseen consequences here on the administrative side that we just haven't had a time to work through. And I think I speak for the entire retirement plan community when I say we're going to figure this out and get the money out to the participants, and we're going to figure it out on the backside. But there's going to be a lot of manual operation here, and there's going to be a lot of error and some cleanup that's required, and that's just part of the deal. All right, so amendments are required to those plans that don't allow the contributions currently, and that will bring us back in a second to when do you make these amendments. The next piece that was included in CARES was a waiver of RMDs, or required minimum distributions. So it used to be that at age 70 and a half, so the year in which you turned 70 and a half, you had to take your first required minimum distribution. So you're forced to start taking this money out so you don't just prolong the tax payment indefinitely. That's the purpose of it. It used to be 70 and a half, but in the year you turned 70 and a half, you didn't have to make the payment until April 1st of the following year. So there are people out there who turned 70 and a half in 2019 and did not make their first RMD payment by the end of the year 2019. So they have until April 1st, or had until April 1st to make it. And maybe they did and maybe they didn't. But that also has been waived. So there's this transitional group of people, because the Secure Act changed the age to 72. But we still have that group of people who turned 70 and a half last year and needed to have made an RMD, their first RMD withdrawal, by April 1st. That group also has a waiver that if they didn't, for whatever reason, make that first withdrawal, they have a waiver until next year. Otherwise, what the Secure Act did, which was published into law at the end of 2019, it changed the required beginning date to 72. And so that would have applied to in a different way to folks depending on their age. So bottom line, no RMD required in calendar year 2020. All right, the amendments. So, a retirement plan, we tend to think of the record keeping arrangement and the website and the funds that are in the plan as being a retirement plan. But a retirement plan is actually just a stack of paper. It is a legal document, 100, 130 pages typically. And whenever you do something different in it, you can't just do it. You got to amend it. You have to make a change. It has to be formal. And so we do a plan amendment, and every single little thing has to be perfectly documented. And it is a violation of law and fiduciary duty to operate a plan in any way other than its written terms. So that requirement still applies. So this relief that's being granted under the CARES Act still requires amendments. So these are mandatory plan amendments for any plan who wants to take advantage of these provisions. Well, that puts a bottleneck on making plan amendments. So the problem with that is if we have to wait to make an amendment before we can take advantage of this, we're at the other side of the crisis. So we need this ability now. So you can take advantage of these provisions now. If you're an employer, you want to implement the $100,000 limit on loans, the 100% limit on loans, the $100,000 waiver of the 10% penalty to allow in-service distributions in the meantime, you have until the end of next year, roughly, to make that amendment. Now, what does that mean? One of the complexities here is that we have two separate amendments we could talk about here. So the law itself is talking about mandatory plan amendments in order to take advantage of these special provisions of CARES. It's not saying an amendment to add a loan provision or add an in-service distribution provision is necessarily in that same category. I think we can probably assume that that is so, but we haven't had enough time to get guidance on that. But this is something that service providers will be working on behind the scenes. And but we go back to that employer who does not have loans or does not have in-service distributions currently. They need an amendment. They don't have one. They're realistically not going to get one in time to take advantage of this in the next few weeks. What do? My own belief would be that that employer is pretty safe saying, I'm going to go ahead and operate my plan as if this amendment applied. Yep, I'm going to go ahead and allow loans and distributions to take advantage of these provisions of CARES. And I'm going to do the amendment later. And all I have to do as an employer, I have to operate my plan in accordance with the eventual amendment. Well, again, I think the employers are going to need help from us in the retirement plan community. We will give it. But life is complicated for an employer who does not currently permit either loans, distributions, or both, in-service distributions or both. But my interpretation is it is possible for such plans to take advantage of this stuff. All right, so what's next? So if you think about all the different problems that can arise in a qualified plan as a result of a natural disaster like we're experiencing now, it's a long list of stuff. And there's more relief needed, and I believe more relief is on its way. So I'm going to talk a little bit about what I think that means. And I do believe that Congress is speaking about phases 4 and 5 and even 6. So there's this recognition that there's just going to have to be follow-on legislation to help with all the problems that are being created. But let's talk about what might be included from a retirement plan perspective in these later phases. So, and these are examples. I have the American Retirement Association to thank for this. I was on a couple of government affairs calls recently. And this is just stuff that's coming in from the retirement plan community about the types of questions that we in the industry are getting from our clients. So one of them is, I can't get into the office to mail out paper stuff to participants and beneficiaries. And that's where all my mailing stuff is. So can I do electronic disclosure? Well, currently the answer is no. The rules do not allow it. Unfortunately, there are a number of employers who are have either already stopped making employer contributions to their plans or are contemplating it. And again, there are rules to that kind of a thing. And so for a safe harbor, the rules were recently changed to permit a mid-year change to a safe harbor, but there's a 30-day notice requirement. Well, can you go ahead and do that without the 30-day notice requirement? Would be a question. Currently, no. If you have a safe harbor plan where you paused because of the coronavirus, can you get a waiver on testing? That one's probably a stretch for the IRS. So the safe harbor, the point of the safe harbor is to allow you to pass testing. If you have this natural disaster that causes you to have to stop your safe harbor temporarily, and then let's say you later resume it, but you hit the pause button and maybe not you contributed, is the IRS going to let you get a free pass on testing anyway? What I'm hearing, and I think what we could expect, is any relief that they gave on testing would be very limited and would require the full contributions to ultimately be made. But that's another request that's come in. What about contributions for last year that haven't been made yet? So let's say that you're a partnership and you don't make your final contributions for the partners until tax filing deadline, and you haven't made, or you extended, and so you haven't made your contributions yet. And now you've changed your mind. You want to go back and not make those contributions. Under what circumstances could a company say, hey, I need to either put off or change my mind on, and I put here deferral, I apologize. Employer contribution waiver or deferral is what that should have said. Employee deferrals are different. But to what extent can I change my employer contribution decisions? Partial termination is a huge issue. So one of the things that's going on is, let's say you're Disney or Delta Airlines, and you are having to furlough employees. So this word furlough has suddenly become a lot more common. And what does it even mean? It is, first of all, I don't know how official the legal definition is, and it would certainly apply differently to different regulators, even where it has a legal definition. And that's one of the problems. So the concept of a furlough is that you're letting someone, they're going home, they're not working, they're not getting paid, and they are eligible for unemployment benefits during that time period, but you do expect to bring them back to work. That's a furlough. So if you do expect to bring them back to work, and yet they're eligible for unemployment, have you terminated them? Well, ordinarily the answer is yes. That would be a termination. And those individuals would be eligible for a distribution, and they would be vested in accordance with their vested account balance. However, when you have a partial termination of an employer, meaning, and the rules are more complicated than this, but simplistically, if you lay off 20% or more of your workforce, that's considered a partial termination by the IRS most of the time. And the consequence of a partial termination is that you have to 100% vest the participants in the plan. So now we have this issue of, hey, we have people who have only been with us a year or two or three. We've put in these employer contributions. If we furlough them, and we have to furlough so many of them that all of a sudden they're eligible for a distribution, well, then they get those contributions that would not otherwise have been vested. And so there's a lot of questioning going on around when do we actually have to trigger a partial termination. Extensions. So the CARES Act actually authorized the Department of Labor to consider extensions, and the Treasury to consider some extensions on various deadlines. But deadline relief is something that is coming and not here. We don't have anything other than a couple tax filing extensions. The Form 5500 is due July 31st on extension, October 15th for most plans, for calendar year plans, and the extension is called a Form 5558. So right now, it's easy to get an extension. You file a Form 5558. So one of the things that's being asked for is, could we have an extension without a Form 5558 automatically? And then other deadline relief is also needed. What about late deposits? The Department of Labor and the IRS audit this ruthlessly. They, if you're 2 days late on getting money into the trust, it's the employee's money. They're not sympathetic to any delays. And I don't know that they would be very sympathetic even under the current circumstances, because it's not the employer's money. But this is one of the questions that's coming up is can we have a grace period on late deposits? Another question that has come up is what about in non-qualified deferred compensation plans, 409 Cap A in the Internal Revenue Code. And this is for key employees and highly compensated individuals at an employer. And so this is not a group for whom the relief is focused, and I doubt there's any relief coming with respect to making elections on 409 Cap A plans, but it is a question that has come up. And another question that has come up is, could we have a short defined benefit plan funding holiday? So, you've got a defined benefit plan, you have to make mandatory contributions quarterly, sometimes more often, certainly annually. You have a certain funding burden. Can we have a holiday on the funding? So funding relief for defined benefit plans is another form of emergency relief that is likely to be requested, is being requested. So will this stuff happen? Well, we don't know. My belief would be that yes, some or all of these will be discussed in future legislation, and there will be then some additional retirement plan relief provisions for us to consider. And I will close and open things up for questions by just saying, I hope everybody is well. I wish you and your businesses the very best. Those of you who are financial advisors taking care of customers, keep at it. I know you're incredibly busy right now, and I am happy to be able to help in what little way I can today. So with that, Brian, what kind of questions do we have?
Yeah, thanks, Pete. We have many lined up here, but if folks have questions to have Pete field today, feel free to enter those in the GoToWebinar questions panel, and we'll get through as many of them as we can. One theme that has come up in several questions just relates to amendments, and I can address part of this. For Epic Retirement Plan Services clients who are using us for the document, we will include these provisions and not be charging for this specific amendment. So if you want to have anything that Pete talked about today included in the plans that you service, please reach out to your Epic RPS client service specialist to initiate that process. And to clarify, I think one thing that Pete said that maybe was a typo or we don't quite agree with is that those amendments, at least from what we have seen, need to be done by the last day of the plan year after December 31st, 2021. So to translate that into a little more simple English, if you are a calendar year plan, we would need to have that amendment in place for you by December 31st, 2022. So that window is a little bit wider than I think, Pete, you described here. If you disagree with that, we'd be glad to talk about that as well as part of our questions today. But I know that came up in several questions. So please reach out if you do need any of these new features included in the plan.
Well, one of the great things about being a pension consultant is that I'm often wrong, but people can rarely tell. So I might have read that wrong. I did read it as the end of the first plan year, beginning on or after January 1st, 2020. That was the way I read it, but I might have misread it.
All right. Well, we will owe everyone some clarification on that, as that'll be important. But the short order and short story here is we can take care of those requests and not have to worry about having sponsors sign a new document at this time. So that, as Pete very clearly indicated during the presentation, that's not going to be the bottleneck here, is actually having the official amendment done and signed. All right, let me rattle off a few more for you, Pete. Could a sponsor implement a COVID hardship distribution limit that is below the $100,000? For example, $50,000, or is this specific and it's kind of all or nothing? Is there any customization, if you will, available in between the former limits and what they are under the CARES Act?
They can do whatever they want, although I don't recommend it. So these are optional provisions. So no employer is required to allow these things. If they choose to allow it, they have to do an amendment, and then they have to follow the amendment. And they can do whatever they want. My suggestion, though, would be do it all the same way or not. Do all or nothing. Either decide to do it or don't decide to do it. And part of my reason for that is somebody has to administer it, and custom provisions are harder to administer and more likely to be done wrong.
We would echo your sentiments on that. Let's see. Here's another one about communication related to loan repayments. Is this something where all loan repayments can be stopped, or is this really at an individual participant level for administration? As in, could someone take the loan and decide to repay it, whereas someone else chooses not to until the grace period is over?
So I believe that the answer is, and I say I believe because obviously I don't have 100% certainty, since these rules are as new to me as to everybody else, even though I've read them several times, that this is in fact a repayment holiday. And in fact, let me go find the slide. The loan slide, I think, is helpful. Okay, oops, that didn't work at all. Well, I was going to try to go back to my loan slide. Here we go. So there's a payment holiday is the way I described it. That term is not in the law, but it does talk about loans being able to not be repaid during this period. And it refers, and my understanding is that applies to all loans. That has huge implications. So I have not had a chance to talk to others in the industry to see how's everybody thinking about implementing such a thing. But clearly written into the law is this concept that payment will not be required. That if you take a coronavirus-related loan, although it doesn't use that term, the law uses coronavirus-related distribution as a defined term. And then it goes on to say that you're eligible for a loan that qualifies under these new terms, meaning payment holiday, $100,000, 100% balance. Those new terms are eligible to qualified individuals. Well, a qualified individual is the same person who qualifies for a coronavirus-related distribution. So the implication is that anyone who needs access to these provisions for coronavirus-related reasons would qualify for that payment holiday. And that's effectively everybody. Does that mean that we should go and stop all loan repayments? Good heavens, no. I mean, participants are going to need to request this relief. And but I do read it as that it would be pretty easy to qualify for that relief and the payment holiday.
Okay. Yeah, thanks for your initial pass on that, and do feel free, Pete, to decline anything that's out kicking your coverage with these questions. We can do some further research on them, but I will leave you that out. Another one that rolled in. Well, before I get to that, many of you have asked whether the slides and a recording will be available. The answer to that is yes on both accounts. We will follow up to all who attended today and those who registered with a copy of the slides and a link to a recording so that you can share those as you see fit. Pete, we've seen some conflicting opinions on whether the RMD waiver is an amendment or optional. Can you comment on that?
I do. My belief is that it is optional, that all these provisions are optional. But the RMD waiver, if you think about the mechanics of an RMD, there are two sides to it. There's the individual side, and then there's the plan side. So there's a qualification requirement in a plan, 401A9, I believe. So, we have these list of requirements, qualification requirements, 401A9, required minimum distributions. Well, and then an individual is required to take money out. And the penalty for the individual to fail to take the money out is a huge penalty. And it's not hard to get relief from the IRS on that. But I feel confident that that part of it, the individual side, is safe. If you don't take an RMD in 2020, there's clear relief. And whatever the outcome is going to be, it's not going to be that you're going to pay a penalty as an individual. The qualification requirement doesn't go away. And so is an amendment required? Is it a mandatory thing? Well, if you have any individual who doesn't take an RMD from the plan, then your treatment of that as a plan is separate from that individual's. So my belief would be you have to make an amendment in order to take advantage of it. And I don't see how you not do that, given that it is an individual as well as a plan thing. It may legally be perfectly okay not to, but I think as a practical matter, everybody's going to need to do it.
Fair enough. Switching back to loans for a minute, are there any implications here for loans that had previously been dispersed prior to the CARES Act in general? It sounds like the repayment holiday might be something that's more global than perhaps was intended, or maybe it was intended that way. But can you chime in just generally on implications for a loan that had gone out prior to passing of CARES Act?
I would love to pull up the language and actually read it to everybody, but difficult to do with the screen still up. But again, this is my interpretation. But what the language says, and remember, this was drafted in haste. So stuff like what that question points to, that would ordinarily have gone back and forth 4, 5, 6, 7 times with people from American Retirement Association talking to various Congress people and tweaking the language to make sure that kind of a thing is answered, and then talking to the service. Well, we didn't have time for that. And so I don't know the answer. I don't know that anybody knows the answer. I haven't heard anybody raise it yet. What I have seen and what I believe to be true is that the payment holiday is a form of relief that is available to anyone who is a qualified individual, meaning that one of those 3-pronged tests I mentioned earlier for the distribution. And that as long as that's true, why wouldn't it apply to another loan? Because if it doesn't apply to another loan, what if you then take out a new loan and re-amortize, because a lot of systems allow that? Well, that's just more work. But maybe that's the way it's going to have to go. But my belief would be that the payment holiday does apply to any loan that can be characterized as being, falling under the heading of the coronavirus related.
Okay, thank you. Related to the distributions, does that apply to an IRA as well? And is there any aggregation between IRAs and plan? And if so, I think that was probably on your
It
first
does
slide,
apply to
but...
it is, let me go back. There is a $100,000 limit per person, and the aggregation is implied that any one individual can't take more than $100,000, and logically that includes IRAs as well as qualified plans. The mention of aggregation is strictly on the plan side, so it mentions this need for an employer to limit coronavirus-related distributions to $100,000 for all plans of that employer, including control groups and affiliated service groups. And I don't believe it does other than imply aggregation at the individual level. But I think we can treat this a lot like we do a deferral. When somebody makes a deferral election, they're only allowed to take out 19 grand a year. So, that's the limit. And if they go over because they, for example, have two jobs, they're still over. And, they can't max out their deferral limit at two separate jobs. I think we can look at this the same way.
Okay. Makes sense. For the 100,000 that's taxable, are the taxes due during the first 3 years or payable after 3 years if the loan was not repaid?
This is, again, I'm reading, my knowledge here is secondhand speculation. So somebody smart speculated and I read what they wrote. First of all, the tax is due now. However, you can spread out the income over 3 years so that decreases the portion that's due now. So you still have to file your taxes. You still have to pay tax on the distribution, but now you're allowed to take the 100 grand and divide it into 3 chunks over a 3-year period. And so you're only paying tax on $33,333 this year, another third next year, and so on. Now, how do you get that back if you repay it? Let's say you repay it at the very end of the last year, all in one lump sum. All of a sudden, you put in $100,000, which, by the way, not with earnings. So no earnings, just going to be a flat 100K. You put that back in. Well, you're already past your taxable year. So how are you going to get that money back? And the answer is you're probably going to have to do an amended return.
Okay. That's a complicated one. Pete, can you reiterate the deadline for someone to decide whether or not they want to take a CARES Act distribution?
I'm pausing because I'm not sure, and I want to go to one of my slides. The time period for this is through 180 days, and I'm looking for the language there. Here we have the loan limit thing. It's for this 180-day period starting March 27th, but sorry folks, I'm thinking that the language is as useful to you as it is to me. The CRD, the distribution, is for anything related to these problems. I don't know that they put a time limit on when you take that. So it's a qualified distribution if it is due to any of those causes, and there's no implied time limit on that. And this is straight from the law, at least in summary form. But we do have this limit over here on the loans. You can read the 180-day thing that I mentioned earlier. So it makes sense that this would be cut off at some point, and that's, I'd say, a logical time frame for them to cut it off would be end of September at the earliest and December 31st more likely.
Okay. And can you comment once again on notice requirements related to adopting any of these provisions? What should a sponsor do if they say, yes, we're going to allow for new loans and distribution provisions? What's their obligation right now to communicate that with participants?
Well, and I'm going to forward to my phase 4 and 5 slide here, that this is a relief we would need logically to answer the question you just posed, but we don't have it. And so in the absence of legal relief, the legal requirement still applies. So as an example, if you're going to amend a plan to include a significant new provision, that would normally require an SMM and a summary of material modifications that has to be mailed physically to some portion of your employee base, if not all of them, and former participants. And the paper notice side of that alone can be a burden. My own sense of this is that we're all in a crisis. We're all trying to do our best, including the government, and you just do it. And the fact that you can't mail them an SMM, you're going to send them some sort of a communication. That's just one example of a requirement that is applicable. And I don't know of a way to proceed other than let's get the relief there to the people who need it. And then those of us like Epic who have to administer the stuff, we're going to have to figure it out.
Okay. Switching to one more non-retirement related question, but something that may come up with advisors and such. If you haven't filed 2019 taxes and the stimulus is based on 2018 tax filing income level, would they claw it back after you file your 2019 taxes if you're over the limit?
It sounds like, I'm not sure what the question relates to, but it sounds like it relates to the payroll protection loan. And I don't know that, I don't see how that would affect anybody. And the payroll protection loan, for those not familiar with it, let's say you're an employer, you have 5 employees, you pay them all $50,000 a year, but maybe one of them gets paid $110,000 a year in 2019. I don't think that the fact that the income level changed and went over 110,000 would have any effect on that, because the limit is on amounts of income over 100,000, as I understand it. And we're outside of retirement plans now, but I don't think that particular thing would be a problem.
And Pete, if interpreted differently in relation to the personal check that someone could receive unrelated to retirement plans, do you have any thoughts on that?
I'm not sure I understand the question.
As in, if I haven't filed my 2019 taxes, so the last income level the government has from me is related to 2018, and under that level I am eligible to receive a stimulus check.
Oh, okay. Yeah, the stimulus checks. I don't know. They could very well claw that back.
Fair enough.
I think if you think through tax filing software and how these things work, there's a series of questions, and you could just picture in TurboTax there being a question, hey, did you receive a stimulus check in 2020? And if you did, then that could be includable in income. And it could also, who knows, could actually be taken back as an additional tax. I'm purely speculating.
Sure. No, fair enough. Well, we just hit the top of the hour here. I know there are more questions out there. We could probably go for a few days on those. We'll try and follow up with as many as we can. But a big thanks again to Pete Swisher and Waypoint Fiduciary, and thank you all for taking time away again from your families and businesses during this time. As Pete pointed out during his presentation, things are happening fast, and we at Epic RPS are working through many of the logistics of administering all of these provisions. We will be communicating with you regularly along the way, and as I mentioned, we will certainly send out a copy of today's presentation and slides. And in the meantime, we wish you safety and health as you support your families, colleagues, and clients. And please don't hesitate to reach out to us if there's anything we can do to help support you. So thanks again to all, and thank you, Pete. Have a great week.
Thank you. Thanks, everybody. Good luck.